We'll keep coming back to this. It always helps to refresh memory. Financial asset arises from a contract. A financial asset is cash, equity instrument of another entity, contractual right to receive cash or receive other assets, contractual right to exchange financial asset or liability under potentially favorable conditions, or certain contracts settled in own equity. Right? With this definition, let us now look at how do we classify financial assets. Financial assets are classified as either fair value through profit and loss account, or fair value through other comprehensive income, or amortized cost. Now, I'll first talk about how do we measure them, and then talk about the basis of. Sure. Mr. Ramanathan K has a question.
No, let them type in the chat box, sir. You can proceed.
Okay, sure. Now, financial assets are either fair value through profit and loss, fair value through OCI, or at amortized cost. And it's important to understand what they mean from a measurement standpoint, because that will then just help us to learn the classification better. Amortized cost, as the name suggests, is an asset which is measured at cost. We will look at the elements later today. But basically, after I have originated a financial asset, whatever happens to its market price does not impact my balance sheet and P&L. I purchased or I invested or I lent money at 100 rupees 10% to a customer. After that, the price of that asset or that investment could be 120, it could be 0. It does not impact the measurement of the asset itself. You will have loan loss provisioning, etc. But per se, the asset is at cost. So assume I invested in a government security, which is absolutely, or which is risk-free if it's in the home currency. If I invested 100 rupees in a government security, it will always stay at 100 rupees in my books, regardless of whatever is the discount rate or the yield environment in the country. Fair value through OCI is a financial asset accounting, where on day one, if you have paid 100 rupees for the asset, every balance sheet date, you measure what is the fair value. If the fair value changes, you recognize that change in OCI or reserves. Right? Two things to keep in mind. The fair value necessarily comes in the books, but it goes to reserves. It does not come to P&L. So it has an impact on net worth, but no impact on P&L or EPS. Again, some important points which management could keep in mind when they make decisions. Because you would want to have an asset at fair value, but if the fair value is volatile, maybe you will want to have it as fair value through reserves, not P&L, because you don't want a volatile EPS, volatile P&L. The most simplest to understand once again is fair value through profit and loss. You have invested at 100, whatever is the fair value change, take that fair value change in P&L. Now, this is basically the end state of how a financial asset will behave in the accounting books. How do you get through the classification? Let's look at that flowchart in a bit now. Right? So I've tried to put this down in a simplistic flowchart so it helps all of us to understand this better. Now the first gating question is the financial instrument an equity instrument of another entity? What could be examples of those? Once again, quickly in the chat box. Examples of an equity instrument of another entity. Investments, yeah. Investment in shares, absolutely right. Preference shares in some situation. Okay. So the point I'm trying to make is we have to link this back to the definition of equity. If an instrument meets definition of equity, or it should have residual interest, then The answer to this question is yes. So in my example, let's assume I am investing in equity shares of ABC Limited. Next question that the standard requires me to assess, do I hold these shares for trading? If I hold this share for trading, I don't have a choice. That shares that I hold as investment have to be fair value through profit and loss account. Right? So we'll go through the steps again. I buy shares of ABC. First question I ask myself, am I holding them for trading? If I'm holding them for trading, no choice, fair value through P&L. Whatever is the change in fair value goes to P&L. The other situation could be, look, I am not holding them for trading. This is when the standard gives an irrevocable choice. That's right. And this is what we're trying to explain, which is the irrevocable choice. And that's one of the questions I saw on the box. Now, if your shares are not held for trading, you have a choice, either fair value through profit and loss or fair value through OCI. And this is where management's intent is important. As auditors, evidencing what management has intended or documentation of management's intent is critical. Who has approved this, where, at what level, what forum does it get approved? All of those become relevant audit evidences. So if I am management and I have invested in shares of, let's say Reliance Industries, right? I don't have any shares in Reliance Industries. Let's assume I have invested in shares of Reliance Industries. Now, I don't hold them for trading, but I hold them for capital appreciation. In such a situation, I will classify them as fair value through P&L. I know the company is a good company, it is doing well, it shows good returns, there is less volatility. But on the other hand, if I have made an investment in, say, one of my key suppliers, it's not an associate, I've held 12% in that entity. Now, this is where there is a choice. Because the moment I have made an investment and that, say, it's an unlisted or a private company, the valuation is that much more difficult. The more difficulty in valuation, the more volatility that could arise in valuation. In one period, you may have a gain, in one period, you may have a loss on fair value. Now, in that situation as management, I could put it as fair value through OCI. So basically, I have protected all the changes in fair value for that instrument from hitting P&L. If it's a loss, it will not hit P&L. If it's gain, it will not hit P&L. Absolutely wonderful till now. But then the question is, what happens if I sell it? Now, this is where the standard setter said, look, you wanted a choice to protect your P&L from a bad day. Now, when you have made a gain on sale, please don't take it to P&L. Very important management decision input. If you're doing any advice to a client, very important to keep in mind that gains will also not go to P&L if you choose this option. If you choose to fair value through P&L, everything goes to P&L, realized, unrealized gains. But here, both realized, unrealized gains will never go to P&L. And this choice is irrevocable. So you can't say that I purchased the investment today, I am choosing to put it as FVOCI. 3 months later, the company has stabilized, I will move it to FVTPL. That is not permissible. That is not permissible. Right? That is an important thing to be kept in mind. No hindsighting, it is not permissible. What is permissible, however, is, say on 1st of April, you bought 100 shares of a company, classified them as fair value through OCI. Now on 1st of July, you purchase another 100 shares. Those 100 shares can be FVTPL. That is permissible. So yes, the answer is the same investment, different tranches can sit in FVTPL and FVOCI. That is permissible. Once you have sold an FVOCI investment, the realized gain, you could put it in a different head under retained earnings. So for example, you could move it from fair value gain loss reserve versus you can make that choice. You can then put it to retained earnings or realized profit or to retained earnings. It cannot come through profit for the period. Yeah, so in summary, held for trading, no choice, fair value through P&L. If it's not held for trading, and remember we are talking about this as the investor, how the investor should account for it, not the issuer. If it is not held for trading, there is a choice. If you don't classify it as FVTPL, it is irrevocable. It is an instrument by instrument choice. Your choice could differ when you make a purchase subsequently. New purchases can go under a different head. Existing purchases cannot go under a different head later on. Now, if that company declares dividends, irrespective, dividends will go to P&L. Even if it's FVOCI, if the dividend is declared by that investor or that company, the dividend can go to P&L. It is only the fair value gains and losses and realized gains and losses that will remain in OCI. Now, this is as far as the instrument that you are dealing with is an equity instrument of another entity. Okay, there is a question on if it is an investment company. If it is an investment company, can we conclude it is held for trading? Well, yes. If it's an investment company, your objective is to make investments, make capital appreciations. Generally, you will take it as FVTPL. It may not be a mandatory thing because it's not necessarily held for trading. But if you look at the underlying business, you will take it as FVTPL. And whatever you choose is irrevocable. So that is also important. Right now, what kind of instruments are impacted by this? Simple classic example, equity shares. Let's take one simple example to cover both the situations. So we've covered how to account for an equity instrument, say an equity share. Now let's take another example, saying what if it is not an equity instrument? Say it's a loan. A company A has given a loan to another company. This is where two tests become important. The sole payment of principal and interest. Basically, the standard asks, what is the nature of the instrument? Is the nature of instrument purely to collect principal and interest cash flows? And those principal and interest cash flows are in the contract. If that answer is a yes, then you look at what is the business model. And we'll pause at SPPI test for a minute now. Basically, the standard asks us to evaluate what are the contractual cash flows. Are they only principal, only interest? Let's take an example of a convertible debenture. In a convertible debenture, there is a repayment which is fixed. Yes, there is principal. Does it have interest? It does have interest. But there is a conversion option into equity shares. Now, that conversion option or the value of equity is what is driving the decision of this instrument or driving the value of the instrument. For such instruments, the standard says SPPI is not met. Right? Again, I'll just quickly clarify, maybe there are a lot of questions flowing, but we are all talking about how the investor does his accounting. I am talking of a financial asset here. I am an investor. I have invested in shares. Question one, is it trading or not? Trading, FVTPL. Not for trading, I have a choice. Now I am saying I have invested in a debenture. What are its cash flows? Are the cash flows only principal, only interest, or something else? If something else, like say an equity conversion, then the accounting is fair value through profit and loss account. Once again, no choice. This is what is called as a hybrid instrument or an instrument which has an embedded derivative. There is a conversion option. It changes the nature of the instrument. Fair value through profit and loss account. There is no further thought behind this. Investment in a mutual fund, and this is a little bit, now we are starting to get into the grays. We'll look at this again later, but if I have invested in an equity oriented mutual fund, SPPI test is not met because there are no contractual cash flows itself. That instrument is automatically fair value through P&L. Right, with me so far? SPPI test, as an investor, look at the instrument, look at only what is there in the contract. Is it principal and interest? If yes, SPPI is met. If not, fair value through profit and loss, only option. Here there is no choice of FVOCI. If SPPI test is met, like you have said, this is a plain vanilla loan or a debenture, simple time value of money, principal, interest, repayment, all are stipulated in the contract. That SPPI test is met. If that SPPI test is met, then the standard says step 2, look at what is the business model. Business model basically means how is it that you manage that pool of debt instruments. So if you have a debt instrument that does not have a conversion option, is a plain simple loan or a debt, SPPI will always be met. In those cases, the business model test basically then says, as management, once you have created that or once you have given the loan, do you always hold the loan to collect to its maturity, or do you originate the loan but you also periodically keep selling it, right, which is held to collect and sell, or is it other business model? So basically, principal plus interest, do you only hold to collect and sell? That is fair value through OCI. But if it is held to collect only, you do not have sales or do not expect to have sales, it is amortized cost. Other business model, FVTPL. Right? Let's pause for a minute. I will once again take you through the flowchart. I think there are a lot of questions on the chat box. I will, if everyone is settled down, let me just take you through the flow again. First question, you are an investor. You have invested in equity shares of a company. Go back to the definition of a financial asset. Is it an equity instrument of another entity? The answer is yes. Right? So here, SPPI is irrelevant. Equity share of another entity, you ask yourself, as the holder or as the investor, will you hold this for trading? If you hold this for trading, fair value through profit and loss is the only option. There is no other choice. If you are not going to hold it for trading, you then have a choice, either fair value through profit and loss account or fair value through OCI. If you choose fair value through OCI, all fair value changes, realized, unrealized, will always be parked in OCI. They will never come to P&L, they will never impact EPS. So equity instruments, that's the flow you follow. If you have a debt instrument, or if you have an instrument which is not an equity instrument, you ask the question, is the SPPI test met? Now, for example, I have invested in shares of a equity oriented mutual fund. As an investor, is there a known amount that I will get on maturity of the instrument? No. In a lot of these schemes, there is no maturity. Second, do I get paid time value of money? The answer is no. I get paid based on how the underlying equity shares perform. In such a case, the sole payment of principal and interest is not met. That will have to be fair valued through P&L. No choice available here. Suppose I have invested in a convertible debenture. convertible debenture is not an equity instrument. Then I have to see what are the cash flow characteristics of the convertible debenture. Is it principal and interest only or something else? The answer is it also includes value of equity shares, which will get converted. Therefore, SPPI test is not met. Once again, no choice. Fair value through P&L is the only accounting choice available. Third type of instruments are your very simple, plain vanilla loans, trade receivables, lease receivables, non-convertible debentures, redeemable preference shares with a market rate of interest as coupon. All of those instruments generally will have SPPI test as met, right? Because you get paid time value of money, you get repaid in principal. They are all predetermined, pre-specified dates in the contract. It's all contractual. For those type of instruments, you look at what is management's intent. Does management intend to hold those assets to their maturity? If yes, amortized cost. Like a trade receivable, right? When a company sells goods, it has trade receivables. Generally, those trade receivables are always held to collect money from the customer. You don't originate them to securitize or sell. Therefore, trade receivables are amortized cost. After you have originated, don't worry about the fair value of the instrument. It will not hit your P&L. But if you are holding debentures, there you may say, look, I am holding them. If I get a good price, I will sell it. So a lot of times companies hold instruments to manage liquidity and say that if they get a good price, they will sell it. Those instruments are fair value through OCI. And finally, if your business model is any other business model, or if it's a trading business model, or you don't know what is a business model, then it's generally fair value through profit and loss. Right. So to give a quick recap, equity shares held for trading, yes, FVTPL. Strategic investment, as management, you make a choice, FVTPL or FVOCI. Now, what is the impact on subsequent accounting? For an instrument if classified as FVTPL, interest dividend income is always recognized in P&L. Any unrealized mark to market always recognized in P&L. Any realized gain loss always recognized in P&L. If you have an FVOCI equity instrument, where you have an equity instrument, you have chosen to do FVOCI accounting. Interest, dividend, or interest always P&L. So dividend always, yes sir, interest or dividend always P&L. Fair value, unrealized OCI, realized also OCI. Right? So this is an important thing to note. This is the difference between FVOCI and FVTPL. If you have an FVOCI debt instrument, interest dividend is in P&L, fair value changes are in OCI, but when you sell them, it comes to P&L. And that's the difference between FVOCI equity and FVOCI debt. Finally, amortized cost, interest and dividend is P&L, and fair value never impacts any books. If you sell it and you make a gain or loss, that goes to P&L. Right now, with that, let's just pause for 5 minutes. If it's okay, we can take a 5-minute break.
Yeah, sure, Pratik. Yeah.
So let's take a 5 minutes break and then come back. We will recap this and then go to SPPI and the others.
Participants need not log off. They can just remain in the room.
Quick break, a much needed break also. So why don't I quickly ask a couple of questions to see if we've got it correctly. So question 1, how would we classify equity shares held for trading? Okay, FETPL, how does dividend on those held for trading shares get recognized? Wow, I'm getting answers even before I'm typing, which is excellent. Everyone is very, very active. I have a investment in a mutual fund, and I'll keep it simple for now. I'll only call it equity oriented. There is some gray, and we will talk about it later. P&L. Okay.